Hello everybody, so today we're looking at a pretty famous quote by the Oracle of Omaha, Warren Buffett, and it is, Rule 1, don't lose money. Rule 2, see Rule 1. So this is obviously one of many of Buffett's statements that he's made, but you can read a lot into this statement insofar as that he's making an analysis and a nod towards the importance of compound interest, because he's basically saying that every dollar or pound that you lose isn't just £1 or $1 that you've lost, it's also the opportunity cost and the future compound return. And he often joked when he was a lot younger, when he was taking a haircut, and he said, like a $5 haircut, he said, this haircut's costing me sort of $25,000, because he was making a joke and an analysis about the importance of compound interest and also the opportunity cost of losing money. Now, why is this important? It's important because often as investors, we enter into what are relatively high risk gambles on shares or property, where often the downside is pretty large and the upside is relatively small. Also, often the odds are against us, because as investors, we're buying something and somebody else is selling it, and often if we don't have the requisite amount of information or knowledge about things, then another Buffett statement was, if you're playing poker in a room and you don't know who the patsy is or who the idiot is, you're the idiot. So he's making a general point that often things are high risk because we don't actually know what we're doing. So this is really important in investing and also saving money, that spending money on things that rust, rot and depreciate, or buying high risk shares like like penny stocks and shares that you don't know anything about, a tip that someone's given you, is really a silly idea, because it's not just the money that you're losing, it's the future opportunity cost of that money that you're giving up. So, and this obviously feeds into some other advice that he's actually given. Recently read Securities Analysis, which is a book by Benjamin Graham and Dave Dodd. Graham and Dodd taught Buffett when he was sort of 20 years of age, and they obviously were really famous investors. And but inside of the book, it's really interesting. There is really the edition I've got anyway has got lots of commentary from people like Seth Klarman and other famous fund managers, and there's a really good quote in there from Buffett insofar as about dumb money. He says that people that don't know what they're doing, they are dumb money, but when dumb money acknowledges their limitations, then dumb money can become pretty intelligent money. And again, what Buffett was getting at there is that when, for example, someone that doesn't know anything about individual stocks buys an index fund, a low-cost index tracker fund that tracks, say, the S&P 500 or tracks the FTSE 100 in the UK, then that investor, over time, if they systematically save into the index fund, will be a lot smarter than investors that try to pick individual stocks when they don't know anything about it. So again, a central core concept of Mr. Buffett was his target of obtaining sort of 15% compound interest per year, because compound interest really turbocharges your portfolio, or really turbocharges your investments, whatever they may be. So it's a really interesting rule. Rule 1, don't lose money. Rule 2, see Rule 1. And it's a very underappreciated rule, in my opinion, because by losing money, the implication of, say, a $10,000 or a £10,000 loss really is hundreds of thousands of pounds to you, because if you were to have placed that money in an index fund, or if it was a larger amount, bought some property over time, over a 20-30 year period, it's highly likely that the stock market would have gone up and you would have had dividends. And with an investment property, you would have had your rental incomes, and the price is generally going to go up with inflation, or maybe a little bit above inflation. So the opportunity cost of losing that money, that say £10,000 or whatever it may be, is a lot more than £10,000. So I think personally we're in a world where people say, dive in, go for it. That's absolutely fine, but you must know what you're doing. If you don't know what you're doing with individual stocks, or you don't know what's going to move a stock, or what's going to make a stock go up, or the financial position of the stock, or how much debt a company has, or how many bonds it's issued, or what its pension fund liabilities may be, or what its general prospects are, you're really gambling. You're basically gambling money, and there could be, you might get lucky, but generally speaking, you're not going to get lucky. So by throwing money into things you don't know about, it is the highway to financial disaster, because you don't only lose the capital. Again, what Buffett says, you lose the future opportunity cost of what that compound interest can give to you year after year in an index fund, or in some commercial property or residential property, or whatever, something which is actually an investment which is relatively low risk. So I think it feeds into like a general psychology in the investment world, as I say, that you have to be active, you have to be doing things. We've got some money, let's buy some stocks. We have to be active. And it's really nonsense, because if you can get, say, 10%, 15% compound interest year on year, assuming you start with, say, $20,000, $50,000, £50,000, whatever, then work it out yourself. Go online and have a look at a compound interest calculator and see what sort of 10% compound interest year on year would give you. So it's really important to bear this in mind. And it also, it feeds into what Buffett talks about, your circle of competence. Don't engage in things that you don't know anything about. Don't open a pizzeria, for example, if you've never made a pizza. Don't start a bar if you don't know anything about bars. If you're going to start a business, go and work in a bar for 6 months, or go and work in a pizzeria for 6 months if you want to open a pizzeria. You have to know the nuance of what you're getting involved in, because you're going to lose your money. You may get lucky and do really well, and that's great for you, but generally speaking, don't lose money. Don't enter into transactions you know nothing about. Where you're at a massive disadvantage. I mean, I read recently that there's something like 2,000 exploration companies in the world, small cap exploration companies that drill for oil and such like, and only 4% of them actually give you, an actual shareholder return. So basically, 96% of those companies are not going to return money to you. Now, if you can find one, then obviously the return's huge. You will have a leveraged massive return. But generally speaking, if you don't know anything about oil, or about oil companies, or about the price of oil, or about the various stages of exploration, or about which companies, like how much debt a company has. I mean, can you even read the financial statements of a company? Do you know how close to production they are? All these things, you're basically gambling your money. Why would you do it? You obviously work hard and earn money, and save and go without things to try and build a long-term financial future. But to engage in such activities is just madness. And again, this is why Rule 1, don't lose money. Rule 2, see Rule 1. And I think it's really important to understand this point. It's really, really important. And I think if investors can keep this in the back of their mind and say, you know, like, I'm going to invest in something today, but it's highly likely that the stock market's going to go up. I mean, on the FTSE 100 at the moment, the dividend yield is like just under 4%. That's so, you know, those dividends, you could buy an index tracker fund and get those dividends. Like, does it make sense, the risk that you're taking on, and do you know what you're doing? And, you know, like, you know, and as I say, like, this is really not an intellectual thing. This is really a question of your stomach. Like, this is your mentality. You know, like, how, you know, can you ignore what everyone's saying? Like, oh, you must invest your money. Oh, you must do this. Oh, you've got money sat in the bank. And obviously, you know, we are currently in a low rate environment. So money in the bank in real terms is losing its purchasing power. You know, that's just you know, just a reality globally. You know, it's just a reality globally. So generally speaking, you know, like, don't rush into investments. Find out, do you have an advantage over the person that's selling you that stuff? If you're buying a share, someone's selling it to you, do you have an advantage over that person? If you do not invest. Walk away, buy an index fund, take low risk options, and don't lose your money. Okay, it's really, really important. So I think it's really fascinating that Buffett, by far the most successful investor in the world, who started with a small amount of money, you know, his maxims and his sayings are very interesting, actually, and very good to delve into and understand the implication and the ramification of what he's saying. So, you know, I think it's really fantastic. So have a great day, everybody. Thank you.